Now, let's get right to the floor show. With $70 billion in assets under management, Alan McKnight is the Chief Investment Officer at Regions. Okay, here we are looking at kind of an interesting, Alan, dynamic, as you say. What do you make of this?
It's incredible. I mean, it's so rare to see, as you just showed those two charts, gold and the S&P 500 both rallying through the roof. And it's really almost this idea of a tale of two cities where you have this belief that the economy is still good, earnings growth, rates are coming down, balance sheets are in good shape, and yet on the other side of the ledger, there's a concern about the geopolitical aspect, trade, and deficits and debt. And so there's this tension, and along the way, market participants are saying, let's just keep buying. And at the same point in time, you get some folks who are saying, if we're not going to roll over our treasuries, let's buy some gold.
Okay, so they're buying gold, they're buying Bitcoin, they're buying oil and all kinds of industrial metals as well, not to mention stocks. So as you look at this interesting behavior and this pattern here where risk on and risk off assets are both on, how do you pick and decide what your clients should have in their portfolio? More
than anything else, it comes back to this idea of finding the best companies, high quality companies that aren't going to be as impacted by the whims and vagaries of the market as you think about, is this sentiment today? Is it going to be only AI driven? All these various facets of it. As long as you can keep driving earnings and pick up some mid cap and some small cap names along the way, because they're one of the only areas of the market, even with a little bit of a lift, they haven't gone up as much as U.S. large cap or emerging markets or even developed international. So there are some pockets that are slightly undervalued compared to the rest.
You know, it's interesting. You look at the Russell 2000. Russell 2000 has actually seen a couple of records so far this year. It's been a while. So in the past week or so, at least two records. We're not there, I think, right now today, but which areas, whether it is the large caps or the small caps, which sectors? Because if you look at, say, for example, utilities,
right.
Utilities pay a nice dividend. Utilities have gone gangbusters this year, up something like 19%.
The thirst for utilities, we actually have an analyst who just came back from utilities conference, and she said she's never seen it so crowded. She said it was wall-to-wall people.
See, I thought
you were going to
say, I thought you were going to say she'd never fell asleep so quickly. No,
exactly.
Whoa,
and now they're excited.
Conference. Woo.
If you had told me 10 years ago, they're exciting. Everybody wants to be in utilities. But it does get back to the idea of certain themes around power and AI and data centers. And the nice thing about utilities, even though they've had this amazing run, they're still only trading at 19 times earnings. So we like that. We like that compared to, say, a tech sector that's trading at 25, 26 times earnings. We actually like some consumer staples. Even though some people are worried about costs going up, about prices going up some, when you look at names like Walmart and Costco, they're still doing quite well. And so there are pockets where you can still make money in this market, but it's not probably as euphoric as a lot of investors think.
There are daily multi-billion-dollar deals being announced in the tech sector, and this question of too much interwoven behavior, whether it is OpenAI with NVIDIA, OpenAI with AMD, Advanced Micro Devices, OpenAI with SoftBank, ARM Holdings, which of course SoftBank is the largest shareholder of. It does make you wonder if there's a little bit too much, incestual relation between many of these names, except that NVIDIA is good for the money. I'm just not sure OpenAI is. They are not profitable right now, and everything kind of hinges on that company.
You're so right. And I will say that's the one thing that makes us think back to the 1999-2000 time period. And I'm embarrassed to say that I was alive and well and investing back then. Mm-hmm. But it feels somewhat like that networking period where everyone had to buy more networking gear. They were just spending money without any real profitability or return on investment there. And that's the place where it gives us a little bit of pause, because we think to ourselves, can you really make the type of money that is required and the return required for a payback in some of these deals? Mm-hmm. And that's where it does give us a bit of pause.
Well, I remember Mark Zuckerberg just a couple of weeks ago telling President Trump that he expected just in the next couple of years he would spend $600 billion. But the math is a little mathy.
That's right.
Considering you look at the cash they have on the books and what their future earnings are. I mean, Meta's a very strong company, but just it's important, I think, to always let our investor audience know that it looks slightly frothy, although what's different is a lot of these companies are profitable.
Well, and I think that's where the old adage, if you don't remember history, you're doomed to repeat it, that there are some elements of that where you'd say, in the short run, the market is going to get really excited and bulled up on growth and revenue growth. But then when you start to peel back the onion and say, but can you make money on it? I think that's where the real winners will be. And over the next probably 12 to 18 months, we'll start to discern who really is going to make money out of this. And to your great point, there are going to be plenty of companies who fall by the wayside.
Good to see you, Alan.
Great to see you.
Thank